Hello and thanks for listening to LOQPOD. My name's Katy Ringsdore. Today I'm joined by Miles Robinson, who's Head of Mortgages at Trussle. Today we're going to be talking about the full mortgage process. Hopefully this should give some insight to people that are thinking about buying a house for the first time. Okay, thank you very much, Miles, for joining me today on LOQPOD. Perhaps we could start by introducing yourself and giving us a bit of information about Trussle.
Yeah, hi, good morning, Katy. Thanks for having me on your show. Yes, my name is Miles Robinson. I'm the head of mortgages for Trussle. We're the first online mortgage broker, and we essentially aim to use technology and human expertise by our team of advisors, case managers to help customers through their home financing journey. In terms of me, I've worked for a number of brokers in the UK, including L&C, Countrywide Mortgages. I helped scale a business called 177 Mortgages, and I joined Trussle in October 19 to head up the advisory teams there, and now I'm responsible for all the kind of sales and operational teams across the business.
Nice busy job then. So what I'm hoping to kind of get from this episode today is to kind of help those people that are considering, getting themselves onto the mortgage ladder. So I suppose if you were looking to get a mortgage, where would you start?
Yeah, it's a good question. It's a bit of a maze, isn't it? In terms of where to start. I think firstly, I'd probably think about your deposit in assessing your finances. Of how much deposit you have towards a property. So, deciding how much you can save per month, how you can afford against all the bills and rent that you may have going out, or still living at home and you're paying housekeeping bills to mum and dad. How much have you got left over each month after your kind of outgoings to save towards a deposit? But once you've got your deposit, really you also need to understand how much it is that you can afford. So how much your income is, and then what that means in terms of a mortgage that you can obtain. So there's lots of tools out there in terms of things called affordability calculators, where you kind of punch in all your income and your expenditure, and it will give you an idea of how much you can borrow. So just an example, if you have income of say £50,000 per annum, easy number, and you roughly may be able to borrow up to around 4 to 4.5 times that once you factor in your expenditure. So that might be kind of call it sort of a £200,000 mortgage, and then you would need at least, at the moment there are 5% mortgages coming back into the market. There's 3 or 4 lenders out there, especially with the launch of the government guarantee scheme. So actually that means you would need a £10,000 deposit on a 95% mortgage against, say, a £200,000 purchase, and then you need a 190 mortgage. So that would be within your affordability limit. So I think doing that homework first around understanding how much deposit you can obtain, the more the better, and then also what you can borrow in terms of affordability.
That all makes really good sense, actually. But I was wondering, because a lot of people tend to go via intermediaries or brokers now. I think I read a stat about something like 70% of people in the UK go via an intermediary or a broker now to get a mortgage rather than directly to a lender. Why do you think that is?
I think customers, in the research, we've done a lot of market research on this. We're the first digital broker, but actually we still have advisors and humans at the centre and forefront of what we do. So, our technology and digital journey is really to help customers, deal with us really when it suits them. 24 hours a day, they can complete our online fact find when they're at work, on their laptop. So it's more about ease of interaction for the customer in terms of our digital journey. When it comes to the actual advice and expertise, the research that we've done is actually customers still want to speak to someone. They still want someone to kind of hold their hand at a crucial point in the journey before they kind of commit and make any decisions. So we still have a team of advisors that help and provide that advice and expertise to the customer before they kind of move forward with any mortgage applications, or even obviously before we actually issue them with a recommendation. And then we have operational teams, case managers, to even at the point their application is submitted, to hold their hand through the whole underwriting process until they actually get that offer approved. But one thing I would suggest, and is recommended, and it's quite hot out there at the moment in terms of properties, is a lot of estate agents will require something called a mortgage in principle, which you can obtain from your broker. We have an actual digital online version of this that you can obtain a mortgage in principle to confirm exactly how much you can borrow. And that is it's essentially a piece of paper that means you've had like a soft credit check done, you've had your affordability check and eligibility check for a mortgage. It's still kind of subject to full underwriting by a lender, etc. But it's essentially saying, look, in principle, this person can obtain this amount of mortgage, and therefore, with their deposit, they can buy a house up to X amount. And where it is quite hot in the market at the moment, there's quite a few people queuing up, for properties, and therefore you want to be in the best position you can be in, really, even before you start house hunting.
Yeah, and that's quite interesting. You were saying there about boosting your credit profile as well. What kind of, it's part of the search for your mortgage in principle. How important is having a good credit profile, and what can people do to make sure it's healthy, perhaps before they apply for a mortgage?
Yeah, it is important. And actually, it's one thing I think certainly first-time buyers, something they're always quite anxious about when they start that process. Is my credit history okay? Am I going to pass the credit check? And really, in order to get your credit into good health, is a few things that I would recommend. I think firstly is to have some sort of lines of credit. So, you might see or hear that having no credit, or don't have any credit, you don't want to be borrowing people if you don't need to. Whereas actually having a credit card, putting your weekly shop or just some kind of regular expenditure on there and paying it off every month, so there's actually no carryover balance, is a really good thing. And it shows to credit providers that actually this person can borrow and they can maintain credit very well. So there's a few online, credit providers that you can use. A lot of them are free now, and you can go on and get a free credit score check, and it'll show you if what your credit score is. So yeah, getting a line of credit. The other thing is being on the electoral roll is pretty important as well. Making sure lenders can find you on their credit checks. But outside of that, I think, even people who've perhaps had some, adverse credit in the past or some blips on their file. Maybe a typical example, Katie, is where maybe someone in their early years might have taken out a mobile phone bill and didn't pay it. They were maybe at university or something like that. And they couldn't quite pay their mobile phone bill, and they got a default over time because they never paid it. That might be £150 default on a credit file. It's actually quite a blip. There's a lot of lenders that will ignore certain values of defaults, and if it is something over a period of time, say 2-3 years ago, there will be lenders that consider it. So even if there are customers, or consumers out there that had the odd blip on their credit file, don't stop the process because you think your credit's not good. Just speak to an advisor. Someone can talk to it and help you understand whether you can or can't obtain a mortgage. And if you can't, they can kind of say, well, look, just give it another 12 months and you're actually in a good place, because that would have dropped off or something like that. So I would say speak to somebody. That would really help. But there are things you can do to keep your credit healthy. But even if it isn't quite so healthy, there are still means and ways of obtaining a mortgage too.
So basically, good deposit, regular income, good affordability, and, a healthy credit file. The likelihood is you'll get a mortgage. Obviously, it depends on the lenders. When you get to that point, what's a good rate? Because I think by the time you get to that point, you've done a lot of hard work, and then it gets a bit scary because they start, the brokers or lenders start talking about things like percentage rates and loan to value and all these scary things. What is a good rate?
Yeah, it's a good question. So a good rate, it's also quite a difficult question to answer, in that it really does vary on the deposit that you have. So, I mean, just to quote, the lowest 95% mortgage out there at the moment is 3.73%. And some consumers might gasp, that's nearly 4%. Well, actually, rates generally across the market are just super low right now, whether you're borrowing at 90, 95%. And when I say super low, it's so low compared to, a decade ago when I first started providing mortgage advice, where the 10% mortgage rates in 2008 were like 5.99. I think I even remember 6.99 rates. And these were high street top 5 lenders. So it wasn't kind of any lenders, who were charging slightly more because of adverse or anything like that. So the rates more generally now are really well affordable. I think the challenge for more customers is less so about rates of interest. It's more around being able to borrow what they need to borrow to buy the house that they want to buy within the area that they live. So, the average earnings of one individual on the average, salary of £25,000 to £30,000 per year, 4 times that as a mortgage of, just over 100,000. Well, there's not many properties you can buy at that level. So you either need to double up with a partner, a friend, and purchase a property to get to the level you want to get onto the ladder. And even then, 2 incomes at 25, 50,000, 200,000 pound mortgage. If you're living in the southeast or London, there's not many properties you can get for 200 grand unless you've got, a big deposit. So I think the rates, my view is that the rates are generally very good. The bigger deposit that you have, if you're into the kind of 25% type deposit, 75% loan to value, the rates start 2%, and that's whether you're fixing for a couple of years or 5 years on that product. So rates generally good, 95%. Clearly, you are paying a little bit more.
And what are the benefits of being a first-time buyer? Because you hear a lot about that at the moment. And, if people are kind of thinking about it and they see they've got first-time buyer status, what does that mean and what are the benefits?
So some lenders do have products for first-time buyers. Certainly some of the top 5 lenders, they might have, certain, like a free survey or free valuation on that product, or there might be some cash back, £500 to help towards legal fees, or just kind of things like that. But I wouldn't get too hung up on those kind of things. It's quite easy to, as a consumer. What we do at Trussle is we calculate the overall cost of the product. So we take into account the whole fees, the rates, any incentives, and then we factor that into the suitability of what we're recommending. So in terms of the benefits of first-time buyers, I think the only thing I would really say is the 95% guarantee is clearly helping there. There's things like Help to Buy as well that's still ongoing in certain in regions. It is capped in certain regions, but that's something that is actually also available to homeowners as well. So I think there's a lot being done more generally across the housing market, which clearly impacts first-time buyers. But is there anything being done specifically for first-time buyers? I think it's a bit more wider than that, I would say.
Yeah, you're probably right there. And it's interesting how that's changed over the years. And Miles, while I've got your brain here, can you explain to me stamp duty? Because it's a bit of a minefield and it's changing all the time. Can you just kind of give me an overview?
Sure, Kate. So stamp duty, it is a bit of a minefield. And actually it's changed quite a bit. So the government last year announced a stamp duty holiday. And that was if you're buying a property up to 500,000 in England or Northern Ireland, you won't pay any stamp duty. You will still pay stamp duties of purchases above £500,000 if you're lucky enough to buy at that level. The stamp duty holiday was originally supposed to end on the 31st of March. And the government made, I think, the right decision to extend that until the 30th of June. Why did they extend it? Well, we had experience of this sort of towards the end of last year, or even in May, the whole half two of last year. There was just an absolute surge of purchase cases and applications. Lenders generally just couldn't handle the volume. They were almost doing, a whole year's worth of applications in a space of 3 or 4 months. So it was just huge, and they were also very busy with things like payment holidays. They just didn't have the capacity. And that's actually why they cut a lot of the high loan to value products, just to kind of slow down that demand, because they couldn't handle the increases of lending. So actually that meant a real big bottleneck of customers that were just going to miss the deadline, with too much pressure on solicitors and lenders to get offers out and get cases completed. So they've extended it. I think they extended it late enough for everyone to still run hard at the 31st of March, but actually just giving another 3 months buffer to make sure there's nobody missing out. So that's kind of how the stamp duty holiday worked. Up to the 30th of June, you're still free up to £500,000 with no stamp duty. If you're buying a second home, so holiday home or buy to let, if you're a landlord, and you've also got another property in the background, there is still stamp duty payable on that, 3% up to the first £500,000, and actually it jumps up to 8% above 500 up to 925. So yeah, it's been a real help, the stamp duty holiday, and I think it really has injected demand into the property market, and it has helped, first time buyers, home movers to move underneath that £500,000 bracket, of course, into new homes without having to pay any stamp duty.
Yeah, thank you for explaining that, Miles, because it really is. But buying a house and taking out a mortgage is already quite stressful, the process, without a lot of the things that are talked about that are really confusing. So yeah, very, very well done there explaining that. So when you're going through the process of buying a house, you have to have a survey done. And obviously, if you've gone out to view a house that's, say, valued at £200,000 and the survey comes back and says, actually, it's worth, I don't know, £150,000, how does it impact the whole process? And could you actually lose the house if a survey comes back positive or negative?
Yeah, this can happen. It does happen in sort of when market conditions are changing. And it can impact the process quite dramatically. I would say though it is still quite rare. So these do happen with purchases, but more often than not, the estate agent has gone out and valued the property of what they feel is appropriate value based on comparisons within the area. They're not a surveyor, to be clear. Some do have surveyors in house, but they're largely valuing the property for sale. And when market conditions are particularly high demand, you might have 2 or 3 buyers queuing up. And in some cases, the house can go over for asking price. And the seller goes, hey, brilliant, fantastic. I'm selling my house for more than I thought I would. But then, yeah, you get a consumer have their mortgage valuation and the surveyor can see that actually, well, this house was valued at 210 and it's now been sold for 200. It was valued on the market for 200. Is the price I've got here, the agreed price of 210. What's happened there? And then quite often those surveyors will actually downvalue the property to the original asking price. So what that then means is your loan to value as a buyer will only be up to the property value. So if you've got a 10% deposit and you're buying the property for, say, or the valuation is 200, that means you can only get £180,000 mortgage. You've got your £20,000 10% deposit, your 180 mortgage, and you're buying at 200. Whereas actually you've agreed the price at 210. So what that means is actually you need the £20,000 deposit you originally had up to the 200, but you now need the additional 10. So the lender will only lend you 180 as opposed to 90% of the 210, which is obviously only a £21,000 deposit, not the 30. So it can scupper the deal, and especially if you're a first-time buyer, you put all your savings into your deposit, your fees, and actually, more often than not, people move into a new house with very little left in their savings. So having to find another £10,000 is quite difficult. So in that situation, even if it hasn't gone for over asking price, I think that scenario is where it's common. If it hasn't, and you have just given asking price at 200 and the value down values it to 180, and you can only borrow 90% of that 180, then at that point you probably should go back to the estate agent and say, hey, look, here is my valuation. Please, can you provide me with some comparables of how you value the property at 200? And if they can do that pretty easily with similar comparables, you can go back to the valuer and appeal that. I've been doing this job for quite a long time, and I would probably say less than 9 times out of 10 will that valuation be overturned, because you're asking an expert to almost correct something that they feel they've done correct in the first instance, which is quite difficult. But the seller might, with that, might look at reducing the price, because clearly the valuation, whoever comes and buys the property next, well, they're going to be in the same situation. So quite often they may well lower the value.
Yep, that makes sense. And how long, on average, does a mortgage process take? So from the moment of me kind of looking around and perhaps speaking to somebody like you guys at Trussle to actually getting the keys to my house, what's the average time now?
Yeah, thanks, Katie. It really can vary, from a no chain to a multi-chain property purchase. So if there's no chain, you can actually get those through quite quickly, 3 to 4 months. For a longer chain, they can take 6 to 9 months, depending on how it's all moving along. The mortgage process, though, to be honest, is probably the shortest part of that journey. Once you've made your offer and submitted your mortgage application, most lenders will turn out a mortgage offer within 2 weeks, and that includes the survey. There are some lenders, in some instances where it's a bit more complex, want more underwriting questions, can take up to 3-4 weeks. And when lenders were really, really creaking in service last year, we were looking at 6 to 8 weeks in some instances for a mortgage offer. But even then, at the worst case of 6 to 8 weeks, actually the longer part of the journey is the conveyancing and all of the inquiries that the solicitor needs to do. That's the bit that takes quite a lot of back and forth. And again, depending on the chain, there could be multiple property transactions where solicitors are doing that. And that's where really then the time frame does go out. But I would say if you're looking to buy a property now and getting it within, say, the stamp duty deadline, I think you're pushing it.
Yeah.
To be honest.
Yeah, you're probably right. And after, your 2, 3, 5 years, however long you take your mortgage out for when you originally buy your house, at that point of, reevaluating your next mortgage, I guess that is remortgaging, I suppose. Do you go back to a broker? Do you go directly to your existing lender? How does that then work?
So we have a recontact strategy at Trussle. So for argument's sake, let's say you did fix in for a 2-year period, we actually start, kind of giving you a nudge 12 months out and say, hey, your deal's up for renewal in 12 months. Let's just keep in touch. You can actually really start the process about 6 months out. It's normally 6 months out because any new remortgage lender will offer a remortgage offer for 6 months, but not all. Some will only offer you a rate for, say, 3 months and honour it. And actually, in some instances, if you want to see what your existing lender will offer you as a product transfer or product switch, that normally happens within 3 to 4 months. So really, you want to be getting your act together within 3 months of your deal being up for renewal. So if we're in April today and my deal is up for renewal in July, end of July, I should probably be starting to think about that now, speaking to my mortgage advisor and saying, hey, my fixed rate's up for renewal at the end of July. What's out there for me? Can I stick with the lender I'm with now and just do a switch? That's nice and easy. Brokers can still help with that. We can give you the advice, is it best to stick or twist, as I always used to say to my customers. And if it's good to stick, we'll help you with it and we'll switch it for you so you don't have to worry about it, and you at least have that advice from the customer. Because lenders, it is so easy now. You can go onto your app and you can literally switch your mortgage rate super easy, which is brilliant for a customer experience. My fear with that as we grow and scale that across all lenders with technology is how many of those customers are not going to get an advice at those points? Is it worth fixing again for 2? Can you reduce your mortgage term? Actually, your income's gone up. Do you want to cut a few years off your mortgage and save some interest? There's those kind of conversations where customers perhaps aren't getting those interventions advice. So I would always say, speak to your broker And then, they can advise you either way. And if it is best to stick, fine, stay. If it's best to move, we'll help you with the application and we'll arrange that as well.
Yeah, and if I look back a couple of years, how, at the point of remortgaging, if you did nothing because you didn't know what you were doing, you'd end up falling into an SVR, standard variable rate, which at the time, a few years ago, was quite terrifying because you'd end up paying so much more per month towards your capital and interest mortgage, for example. Whereas now, I suppose, it wouldn't matter so much because rates are so low. But equally, like you're saying, you need to make sure it's still affordable for you and that you are getting the best rate based on your own situation. But SVRs aren't quite scary as they used to be, are they?
Yeah, they're not. Some lenders are. And it will definitely, more often than not, it'll still be higher than your fixed rate period. So if you're paying 2% on a fixed, your standard variable rate is going to be 4 or 5%. And if you've got a £200,000 mortgage, well, you're going to be paying £200 more a month, which I'm sure you'd rather be spending on other things, especially now the world's starting to open up a bit. Definitely don't let that happen, and start thinking about it early. And if you're dealing with a good broker, you can literally have your mortgage offer done and dusted with a month's, notice in advance. All the conveyancing is breezy. The customers that come to us when it's 6 weeks before that deal, we'll work hard to deliver it for you, but the truth is that's really tight. We need to get a mortgage offer done. We need to, all the conveyancing bits needs to be done to swap it all over. And all of that stuff does take time, and things will take a little bit longer than they were before. Call out to my customers would be, let's get it going 3 months, 4 months in advance.
Yeah, that's good advice, Miles. Well, thank you so much for joining us on LOQPOD today. It's been really interesting kind of picking your brains on the very complex process of mortgages. You explained it very well, but thank you very much indeed for joining me.
Thanks for having me. Thanks, Katie.